George Hoguet, you're a global investment strategist at State Street Global Advisors. The emerging markets had a huge backdrop last year in May. Did that take you by surprise?
Actually, it did not surprise me because emerging markets historically have been characterized by volatility. In addition, emerging markets frequently attract hedge fund and hot money flows. What was surprising to me, however, was how the market confused the end of tapering with the potential normalization of U.S. interest rates, which are two very different phenomena. And of course, since May of last year, we've seen a significant rally in emerging markets, and this sell-off proved to be temporary.
You just said emerging markets always had backdrops in the last, 20 years. Doesn't that hurt investor confidence, also for the future?
Well, emerging markets are about 1.25 to 1.5 times as volatile as developed market stocks. This reflects, of course, their susceptibility to external shocks as well as political risks. But investors have been richly rewarded for maintaining a strategic allocation to emerging markets, which since 1988 have outperformed global equities by roughly 2% per annum, and over the past 10 years have outperformed by more than 6 or 7% per annum. So risk and return tend to go together.
So we have in Europe some countries which have close emerging market status according to the rating agencies. So where would you more invest these days, in Europe or in emerging markets?
Actually, I would invest in both, but I think you make an important point, which is that the distinction between emerging and developed markets is actually quite difficult in some cases to make. Greece and Portugal were classified as emerging markets by MSCI roughly 12, 14 years ago. Then they were graduated to developed market status, and now Greece is back down to emerging status. But conceptually, GDP per capita alone is not enough to make the distinction between emerging and developed markets. So China has a much stronger bond rating than many developed countries in Western Europe. So I think that investors should think about a very, very broad opportunity set, obviously paying careful attention to valuation levels when they enter the markets. So right now we're overweight both European equities and emerging and neutral to emerging market equities.